Futures are pure evil. Your deposit will vanish faster than you can blink. But only if you break the basic rules. And that's exactly what I'm about to explain. If you have a clear strategy and a bit of patience, futures can be an amazing tool to make money in any market. Market going up, you go long and profit from the rise. Market crashing, you go short and earn from the fall. But wait, isn't that a bit too perfect? It can be, as long as you stay disciplined and manage your risk smartly. And yes, there is plenty of risk, but I'll teach you how to spot and avoid every single one. The biggest risk? You can borrow massive amounts of money from the exchange. With just 1,000 you can open a position worth $100,000. Let me say this right now, don't do that. Here is why. Imagine you've never worked out in your life and you walk into the gym. On day 1 you grab a 100 kilo barbell. And well, the result is an injury. Same with futures. So today we'll grab the empty bar and learn the technique. In this video I'll give you the absolute fundamentals of futures trading, from interface setup to risk management. But first, why futures and not spot? Isn't spot safer? Maybe, but futures come with two major advantages. Number 1. Lower trading fees. On spot, 0.18% for market orders and 0.1% for limit orders. On futures, just 0.1% for market orders and only 0.036% for limit orders. And number 2, you can short the market. That means earning when prices drop, something you can't do on spot. Now that's clear, we need to pick a platform. Let's agree on this. The goal isn't to memorize buttons on a specific exchange, but to understand when and why to press them. Everything I'll show works more or less the same on most platforms. Personally, Bybit is the most reliable and user-friendly exchange right now. If you don't have an account yet, check the link in the description. You'll get a sign-up bonus of up to $30,000 for trading. There's also a full playlist of tutorials on how to use the exchange. Sign up, come back, and let's start practicing right now. The first step: choosing your margin mode. This determines how your trades are backed. A lot of people say use isolated margin because it's safer, but there is a little catch, and we'll get into that next. If you choose it, each trade will use a strictly defined amount that you set. And if the price suddenly spikes or crashes, you could get liquidated before you have time to react. If you choose cross margin, all your funds from the trading account will be used in the trade. You'll be able to increase or decrease your position at any time. This option suits us better because it offers much more flexibility. You won't have to worry about the position closing at the wrong moment. The danger is that if the price keeps rising or falling non-stop, you could lose a large amount of money. But throughout the video I will explain in detail how to avoid that with 100% certainty. So if you approach futures consciously, there is no chance of losing your entire deposit. Second point, position mode. Turn on hedging. It allows you to open both long and short positions on the same coin at the same time. If you make a serious mistake, like opening long and the price starts crashing, you can open a second short position on the same coin and offset your loss. Check the box apply to all pairs. It also makes the interface more convenient. You get buttons like open long, open short, close long, close short. Much clearer, especially for beginners. Now let's make sure our trades are displayed in dollar terms. Click here and enable the by cost option. By amount means by the number of coins. You'll have to think in terms of price. If it's Ethereum or Bitcoin, you'll be dealing with tens or thousands. If it's meme coin, then thousands or tens of thousands of units. In USDT format, it's much easier, just pick $100 and regardless of leverage, your trade will be exactly for that amount. Now pay attention to the percentage slider just below. Here's what you need to know. Don't use it. It sets your trade size based on the maximum amount you can borrow from the exchange at the current leverage. For example, if your deposit is $300, you accidentally set 100x leverage and select 50%, your trade size would be $12,500, 40 times more than your deposit. This is one of the easiest ways to get liquidated, so always set your position size manually. Now let's talk more about leverage. It's a multiplier that boosts the size of your trade by up to 100 times. This is done using borrowed funds from the exchange. But how does it actually in practice? And is it always that dangerous? If you open a $100 trade with 10x leverage, only $10 comes from your account and the other $90 is borrowed from the exchange. If you open a $100 trade with 2x leverage, $50 your own money and the other $50 is borrowed. Simple math. At the same time, you could take your $100, set 100x leverage and open a $10,000 trade, of which $9,900 is borrowed. But you'll get liquidated almost instantly and the exchange will take your $100. So how do people lose money here and lose a lot? If your deposit is $300 and you open a $300 trade, the price has to move 100% against you to lose everything. If your deposit is $300 and you open a $600 trade, only 50% move against you is enough, and so on. The more borrowed funds you use over your own deposit, the higher the liquidation risk. While a trade is open, your deposit serves as collateral. That's the money you use to bet on price going up or down. And if you are wrong, the exchange takes that money. Conclusion: don't open trades larger than your deposit, and you will be fine. To illustrate, open a $30 trade with 2x leverage. There is no liquidation price because the position is too small for the price to even reach that level. You've got $15 of your own funds and $15 borrowed. Now switch leverage to 10x and still no liquidation price. That's because we are staying within our deposit. As you can see, leverage can be adjusted anytime. Now let's open a $600 trade. Since that's more than our deposit, a liquidation price appears around $1,340. That means if the price drops to that level, the exchange takes all your money. That's about a 50% price move. Now let's try a trade 3 times bigger than our deposit, and the liquidation price is now around $2,000. I think the mechanics are clear. The more you exceed your deposit amount, the faster liquidation comes. Here is a simple formula. Divide 100 by your leverage and you get the percentage the price needs to move against you to lose all your money. Let's go through a few examples. You borrow twice as much as your deposit. $100 divided by 2 equals 50% price move to liquidation. You borrow 10 times more. $100 divided by 10, just 10%. Price move to liquidation. But here's a nice feature: you don't pay any extra fees for using leverage. The exchange charge a fixed percentage based on the total trading volume. I mentioned these numbers at the beginning of the video, and it doesn't matter if your leverage is 1x or 100x. So why would the exchange let you use all that money for free? Because they want you to open a trade with 50x or 100x leverage using your entire deposit and get liquidated immediately. Exchanges make their money on liquidations. But if you don't go beyond your deposit, liquidation isn't something you need to fear at all. There is a simple and brilliant strategy for that. Only open trades worth 10% of your deposit. Doesn't matter what leverage you use. the trade amount should be fixed. In our case, 10% equals $30. So we open each trade with no more than $30. By the way, that's the minimum order size you can start with. That's why the entry threshold here is relatively low, just $300. This way you completely eliminate the chance of losing a large amount of money. But can you still earn? That depends on how you look at it. First, you need to understand how much you can earn from a single trade. It's easy to calculate. Take your trade size as 100%. You open a trade with 1x leverage for $30. The price moves 5% in your favor. You earn 5%. That's $1.5. Now, if you increase your leverage, will that boost your profit? At first glance, it might seem like it will, because if you enter a trade with 1x leverage, a 5% price increase gives you 5% profit. That's $1.5. But with 2x leverage, the move would be 10%. Seems like more, right? Yes, but the profit is calculated from the amount you personally provide as a margin. In this case, 15 USDT. So the profit is still $1.5. These are just fancy numbers that don't actually change your earnings. $30, 5%. $1.5 profit. $15, 10%, $1.5 profit. Now let's figure out how much can you earn over time. If you have a $300 bankroll and earn $1.5 each trade, that's 0.5% of your deposit per trade. 4 trades a day, 20 trading days a month, your deposit grows by $120 or about 40%. No bank in the world gives that kind of return in dollars. But that's an ideal scenario, and real life is rarely perfect. You could also go all in with 100x leverage and lose your entire deposit in one trade. Once you gain more experience, you can increase your trade size. Until then, stick to no more than 10%, ideally even 5% of your deposit. This way, it's physically impossible to blow up your account. Our goal is simple: to stay profitable over the long term. And that's possible without sweaty palms, sleepless nights, or high blood pressure. 2 more simple things will help with that. First, always use stop loss and take profit orders. Second, enter positions gradually, not all at once. Of course, this is far from everything you need to know about trading. To make consistent profits, you have to keep learning and surround yourself with people who actively trade. That's one of the reasons we have a free trading Telegram channel, where skilled traders share solid setups every day, a resource I personally use and recommend. There is a link in the description, and until the end of this month, it's completely free for new viewers. Starting next month, all subscription will cost $40. Don't miss these chance. But now let's get back to futures. Take profit is used so you can open a trade and then go about your day. It's best to set it based on a percentage price change. Here is how. TPSL Advanced. Select Trigger by Price Change 5%. That means if the price increases by 5%, you get $1.5 in profit and the trade automatically closes. You don't need to wait for the price to go higher. The idea is to open lots of small trades like these. Stop loss works just like take profit, but in the opposite direction. If take profit locks in profits, stop loss limits losses. Set it to 2.5%. If the price drops by that amount, your trade will automatically close. You can view and cancel take profits and stop losses in the Open Orders tab. TPSL. It's your seatbelt. Without it, you could keep losing money until your entire account is gone. If the trade is successful and the take profit hits, you earn plus 0.5% on your deposit. If the stop loss triggers, you lose 0.25% and move on to the next setup. Here is how it looks in numbers. Even if you alternate between wins and losses, you'll still come out slightly ahead. Visually on the chart, if the price reaches the take profit level, the trade closes in profit. If it hits the stop loss level, it closes in loss. You can even drag them around directly on the chart. But you can also trade without stop losses. You'll just need to do a bit more work with the chart. I have a separate video on my channel explaining the basics of technical analysis. It's linked here as well. It covers everything from scratch. Why some candles are green, others red, why one line is thick and other is thin. I break it all down to the molecular level. If you are serious about trading, you absolutely need to watch that video. Now, the strategy without stop losses. You divide your trade into 2-3 parts. With $300 you don't have enough room to scale in, so this only works with deposits starting from $1,000. So the total trade size is $100. We opened the first trade with $50. We set a take profit at 5%. Just in case we're right. But if the price drops to the first support zone, down 3-4% to this level, we add another $50 to the position. And here is where the magic happens. Your average entry price shifts to this new level. If the price moves back here, you are at break-even. If it moves higher, you are in profit. You can do the same with 3 entry points, but remember the one and only rule: don't exceed 10% of your total deposit, because if the price keeps dropping, the loss will only get bigger and harder to recover from. That's why it's important to learn how to admit your mistakes and move on. You can close a trade in 3 ways: by clicking market here, clicking the cross on the chart, or using the close button here. So here is the bottom line. Deposit your funds, divide them into 10-20 equal parts, and throughout the day open many small trades. Set take profit at 5% and stop loss at 2.5%. Or skip the stop loss, monitor the chart actively and scale into the full trade size step by step. If you have already mastered these, then move on to learning our 22 core strategies. They are already available in our Telegram channel, clearly explained just like in this video. Or simply subscribe to our channel. We'll be releasing these strategies as a standalone video soon.